Traders seem to spend an inordinate amount of time attempting to optimize their systems, and I do have a few concerns with that. My primary concern is that there's a failure to understand that optimization is retrospective, not prospective. It is a look-back process, not a look-forward process. The other point that concerns me is that there doesn't seem to be any real attempt to remove sources of friction from the trading system itself. And friction can have many faces. It can be a psychological friction. You might be attempting to trade a system that you are not psychologically capable of doing. There is nothing wrong with that. There are no hard and fast rules as to what sort of system you have to trade. The only rule is the system must suit your psychology. Other sources of friction tend to revolve around the system's interaction with the market. Is it as efficient as it possibly can? And what has prompted me to look at this notion of simple sources of friction is this headline. As we all know, Silicon Valley Bank on Friday collapsed, taking with it the collective fortunes of a lot of very dodgy startups and people who promote shitcoins. So we're all very disappointed in that. But what this has prompted me to do is to look at a primary source of friction that people have. And it is this notion that they need to look to others to tell them what to buy and sell. And so I had a look at Silicon Valley Bank, and I had a look at what analysts were saying about it. And I want to start with this chart. There's a few things here to unpack. This comes from Raymond James, a brokerage group in the US. And there's two main parts. The chart at the top, table down the bottom, and I'll talk about the chart at the top. The white line is the share price of Silicon Valley. The yellow line is the analyst expectation as to what price it should be. The small green diamonds that you see are buy recommendations. This particular firm, this particular analyst, were recommending this stock all the way down. There was no recognition that the stock was in a downtrend. And if you look at the table down the bottom, you see a constant string of outperforms as recommendations right up until the day the bank was shuttered, when it was downgraded to market perform. So I'm assuming that the analyst assumes that the entire market will now be shut, because that's the implication of this sort of thing. But not wanting to tar an entire industry with a single chart, I went and had a look at a site I sometimes look at for these sorts of charts called Market Screener. And Market Screener looks at consensus views of what analysts think about various stocks. And these charts come from that site. And so there's two on the slide here at present. The one on the right is a share price chart, looks vaguely familiar to the one we saw before. The small little table on the left looks at what the mean consensus is. The mean consensus was a hold. The number of analysts, 17. The last closing price, which was a disastrous $106. Average target price, 248. Well, there's absolutely no hope whatsoever of hitting that. Intriguingly, there is a high price target of $308, which is somewhat optimistic given that it's now disappeared. What is interesting is the spread of recommendations. Now, remember, from January, this stock was in a downtrend. But despite that, the consensus was either hold, outperform, or buy. So the general recommendation from the majority of analysts was people should buy this stock, despite it being in a downtrend. You've now identified a source of friction. The source of friction is someone is telling you something that runs completely contrary to your own observations in the market. So what do you do with that? Because you now have a point of tension. And the moment you have a point of tension, you have a point of confusion. And people tend to abrogate responsibility to what they presume to be a higher authority. So the natural tendency will be for people, in the main, and I am speaking about the majority, to push their decision making off onto someone else. So they will follow the broker's recommendations. Now this seemed eerily familiar to me, so I dug through my archive of bibs and bobs that I've collected over the various decades, and it reminded me of Enron. And it reminded me in particular of an analysis I had done of the analyst recommendations around Enron. And for those of you who don't know Enron is, you need to get off your backsides and do a little bit of research, because it is part of market history. Market history and understanding market history removes friction. It removes friction because it removes surprise. Surprise is costly. If you are surprised about things, then that will cost you money. And you are only surprised about things if you are ill-informed. I do understand that for vast numbers of investors and traders out there, they think the market has only existed for as long as they've been trading. Here's a newsflash for you. It's been going a lot longer than that. But back to this little graphic. There are 4 points to this graphic. A date line along the top, the name of brokers along the left, price along the bottom, and what the broker's recommendations were at various points in time. What is interesting to know in summary is that the majority of brokers continued to recommend that Enron was a buy long after the Wall Street Journal had spotted it as a scam and long after the SEC had begun its investigation into it. So here we have a point of problem. And that point is that are analysts acting in your best interests? And I think the overwhelming response to that is no. And the evidence for that is overwhelming. And this is from a piece by Dave Barry, who is a humorist, who sums it up perfectly. He says that Wall Street relies on stock analysts. These are people who do research on companies, and then, no matter what they find, even if the company has burned to the ground, enthusiastically recommend that investors buy the stock. So this raises the question as to why does this occur? Why is there this schism between reality and what analysts recommend? And the simple answer is one of bias. The financial industry is full of bias. It runs on bias. That's just the way it is. And it does so simply because of the amount of money that is involved in it. I did a quick scan of some papers I had that looked at the notion of what are known as sell-side ties. And the ties refers to people going to the same school, people belonging to the same clubs and the like. And it found some interesting things. And these are universal findings. They apply to every market. Analysts who attended the same university as the CEO of companies they cover are more likely to issue favourable recommendations for those companies. This effect's particularly strong for those who attended the same undergraduate institution. Analysts who have a personal connection to the CEO, such as being members of the same fraternity or sorority, here in Australia you could put club, are more likely to issue favourable recommendations. The effect of personal connections is stronger for smaller firms and for firms with less analyst coverage. There is also some implication about the performance of these recommendations, in that some do seem to generate mild alpha, and alpha being this notion about performance. I would posit that because of the close relationship between CEOs and analysts, that what they're actually measuring there is insider trading. There is another point as to the lack of realism regarding analyst calls. Thomson First Call, a research firm, found that in their analysis that 50% of all recommendations were buy side, but only 1% of all recommendations were sell side. So let's put this in context and think about that logically. Is it possible that in, say, a market the size of, let's pick the ASX, let's say it's got a round number, let's say there's 2,000 stocks in it, that only 1% of those stocks would be a sell and 50% would be a buy. That in and of itself defies logic. And when I dug this slide out of the archive, I also dug another one out, which was research I looked at many years ago, as you can see by the timeline that I had here. And what you're looking at is the ratio of buy to sell recommendations. You'll actually see that the ratio was negative in 1983. It went to 4 to 1 in 1990, 8 to 1 in 1995, 48.2 to 1 in 1998, and that tallies with Thomson First Calls figures. I actually gave up doing this when I found that the ratio of buys to sells was approaching 100 to 1. But there is a small nuance to this that I want to point out. Look at the figure for 1983. There were more sells than buys. For those of you who understand market history, 1983 was the turning point of the Australian market, where it entered a 4-year bull market, where it was actually one of the world's strongest performing markets. Analysts got it completely wrong there. And this is something I'm familiar with because I had begun my trading at that stage. So in terms of a summary, what do we think about analysts and their recommendations? Well, this sums it up very well. It says an investor might expect advice that is free of both psychological bias and self-interest. Instead, they discover belatedly that the advice is a mixture of wishful thinking and self-serving hype. And it's the self-serving hype I want to concentrate on for a moment. It's necessary to understand how the majority of broking firms work. The larger ones are split into two sides. One is what you would call corporate or mergers and acquisitions, corporate advice. The other is the self side that most people interact with. The majority of the money is made through the corporate advisory side. The corporate advisory side would be shot in the foot if companies they were recommending and advising were presented as sells or not being very good by the advisory side. So both sides have to work together. And you have to remember that at the heart of this is a desire of a firm to make money. An advisory firm that went around saying that, look, the companies we cover, most of them are rubbish, we wouldn't touch them with a barge pole, would not get any form of advisory work. And advisory work is immensely well paid. So now we need to come back to how do we solve the problem of stocks such as Silicon Valley? Well, the answer is really quite simple. Never follow anyone's advice to buy a share in a downtrend. And all I've done here is plotted a very simple 30-period moving average over the price. You're now clear of all danger because you're not buying a share that's in a downtrend. You're only buying shares that are in an uptrend. That in and of itself seems fairly self-explanatory. But unfortunately, if you look at the bottom of this chart, you'll see volume plotted. The scale's a little bit skewed because of the panic selling on Friday. And in simple terms, for every buyer, there is a seller. For every person who was selling out of this stock going, look, I'm not very comfortable holding a stock in a downtrend, there was someone going, I'm very comfortable holding a stock in a downtrend. And they're still holding it. And as a final lesson, you know you are completely stuffed when the last candlestick you see in a chart merges with the volume.